So, pretty intense week. We had the tariffs come out. Initially, there was the leak that came out where it was 10% tariffs across the board. The market loved that. Bonds hated that. So that was just confirmation that it really is about fixing the deficit problem. And 10% tariffs across the board would not fix that problem. But
At
then,
least the administration didn't think that was acceptable. Now,
yeah,
how they calculated the tariffs and their methodology behind it, probably a bit on the rough side, to say the least.
yeah,
We're
it was
putting
like
we're
a very basic calculation. How
yeah,
accurate
very
that calculation is, like, can you really consider what those countries are doing as tariffs? Like, they had currency manipulation in there as well, which we know China does a lot of that. That's why they were one of among the top tariffed countries. Which do you really is that really a tariff? Just manipulating your
well,
currency like that?
I mean, obviously, like there are some countries in here that got hit kind of hard with tariffs that on like Thailand for 36%. Um, it's rough out there right now for these countries, but I think what's going on specifically is the way that Trump's trying to balance trade quickly, and I think that the reason why these things are happening the way that they are, and like the way that they're so nonchalantly, I guess, rough with their implementation, is if you look at it from a deficit standpoint. We always touch on this, but like 50% of the deficit is interest expense, right? So to bring down that interest expense, you have to bring in fiscal spending, right? And to bring in fiscal spending, you have to be willing to cut the major things in the government that the government no administration, Republican or Democrat, are willing to cut. And Trump's also on the on the backhand promising tax cuts. So his like for him, the only way he can really slow the economy is if they're going to keep spending somewhat consistent, at least on the top layer. Obviously before some of these government employment cuts hit the bottom line in the next year or two. Um, they have to this is his only way of doing it, right? And I think what he's trying to do is just simply put brakes on the economy in a way that, like, to him is most logical, right? Like, uncertainty breeds uncertainty in the market. Like, the more uncertain people are, the more uncertain things become, and it's a vicious cyclical cycle that washes itself out after some point. Where the bottom washout point is, we don't really know yet, but it's quite clear that the market's also a little unsure as to what exactly is the end goal here. Like, I said earlier, 30 something percent on Thailand, a lot of these countries. Where do those tariffs actually end up? Pretty much everybody got a tariff the other day. So the question now is where do those tariffs get walked back to? And I think, like, the market obviously presumes that those tariff levels will get walked back, because if they didn't, I don't think bonds would be where they are, and stocks would be obviously much lower as well.
Yeah. And there is such a large disconnect between the effect that we saw on stocks versus the effect that we saw on bonds. When you normally get a 5% drop on the NASDAQ in a day, you would expect more than just 0.5% move up in TLT. And I think a part of that is affected by the dollar because not only is there now uncertainty with the tariffs, but there's also uncertainty in the dollar and the future of America. With these tariffs, you're pretty much losing the dollar status in a way. You're forcing countries to work with each other rather than with America. And I
Yeah, I
think
mean,
that's been pushing that's been a weight on bonds because now there's that reserve status currency implication that is also in there. Obviously, America's not going to lose their reserve status anytime soon, but there is less reason to have dollars if all these countries start trading with themselves instead of with America because of these tariffs.
yeah, that's something that I think has been going around a lot lately. people are saying that Donald Trump's the most pro-China president we've had in a long time, right? Because in reality, what he's doing, these tactical I don't know, these brute tariff implementations, while he's looking at it as the art of the deal, right? The way he's implementing things, they're essentially, he's essentially backdooring America into, taking a step back from China, and then China's going to go outsource the supply to any other possible country that they can, right? So instead of basically by breaking down the American to the bilateral relationship between America and China, fracturing that relationship will allow other countries to come in together and kind of mend that relationship and kind of take some of that U.S. or quote unquote dollar dominance away. But that's like the theory, and to some degree, it has some merit, right? But it's not. I think it's a bit dangerous because at the end of the day, America is a consumption powerhouse, right? There's a reason why we have trade deficits, right? There's a reason why these things happen. America is a big global consumer, right? And I think that regardless of this administration's effects, we also have to keep in context that these companies in these countries know they're dealing with someone for 3.5 or whatever more years, 3.25, 3.75 more years, right? This is a 4-year process here. There's a lot of damage that can happen in 4 years. Tariff levels are quite high and egregious, but at the end of the day, there's an end to this story to some degree, right? Because like there's a point at which people will just say whatever, let him do what he wants, and we'll just walk it back later.
Well,
Well, somebody
didn't
else will
Trump
come in and we'll negotiate.
didn't Trump say that there is a way for him to get a third term?
Yeah. So the theory behind that is it's pretty interesting. From what I've read, the theory behind that is they run Vance as president and or someone else, and he goes in as VP, and then the president would then resign, forcing him from VP to presidential role. And this way, it wouldn't be considered a third. It wouldn't be considered a third election. That's what the theory is. I don't know how proven or viable that is, but I don't think that's going to happen. Honestly,
No,
I don't
that
think
would
that's
be
going to
so insane if that happened.
happen. Look, the guy's a troller to some degree, right? The guy's a jokester. He's a TV personality at heart.
Yeah,
So when that has its positives and its negatives in government, and especially in the government. Like you need someone with charisma and the ability to shrug off hostility and also manage it well, but you also get the typical Trump, like when he says it's possible to, run it for a third term, obviously he's going to trigger almost every political I mean everyone from the middle to the left is going to get triggered with that. So
yeah,
he just,
yeah.
I mean, but yeah, so not to get too political, but I do think that there is a hit here at the dollar. That's probably, like you said, weighing on bonds a bit. I mean, bonds just haven't seen that oomph. Like for some perspective here, and we'll go into the bond dynamic a little bit, but let's look at the 30-year. The 30-year yield is at 4.47%, right? So interestingly, in September last summer, when we had that bond rally, which we were riding long, the 30-year got down to about 3.9%. Okay. And if we just throw equities on top of this just to see like a comparison here, what you'll notice is like we're pretty much down to the same point we were in equities back in August, yet the long end isn't. So this opens up the discussion. Well, okay, is the long end mispriced at these levels? And I think if you really look into what's going on here, we have NFP tomorrow, and I want to break down. I think this is a good place to do it. The situation with labor at the moment, because we saw today the challenger job cuts come out, basically blowing out to the upside. Some survey employment data coming in weak as well. So there's obviously some signals there that there is some flow through to labor. Continuing claims continue to rise, but the unemployment rate is at a position where we've been range bound pretty much since July. And going back to that market decline I spoke about a couple of minutes ago, when the NASDAQ dove in August, what happened was we had this massive acceleration in unemployment. And a good way to look at this is to just look at, let's see if we can add a SAM rule to this. And this was the talk of the town last year in the summer, but I think it's important we bring it up now to talk about how it is going to play a role here in the following unemployment print. So SAM rule cracked the 0.5 mark in the July report, and that's when we saw labor accelerate its momentum up. The unemployment, actually, I shouldn't say labor, I should say unemployment accelerate, right? And this had a lot of people screaming, "Oh, the SAM rule is triggering recession, recession, recession." And the situation we're running into right now, and this is why this is very important to this specific environment, is the momentum, which is essentially what the SAM rule is a momentum indicator of labor, has been decaying. So if you look here and you just zoom out on the SAM rule, what you'll notice is that we've been falling pretty much since the fall of that unemployment spike. We got the fall, the winter. Labor's been going sideways, going down. Oh, we should probably unemployment rates. Sorry, got the unemployment level on there. That was a little bit of a mistake, but that's okay. So here, go. This there we go. So we have this chop sideways, and we're fading lower, right? So we don't have this acceleration in unemployment. Now, what the SAM rule is telling us, forget about the values. The values are irrelevant right now. Focus on the location. The momentum's been decaying so much here on SAM rule that if we come in and expectations are slightly above, we're not necessarily going to shift that momentum in the labor force market and in the unemployment market. And I think that this labor force dynamic is probably what bonds are a little bit weary about, because last year when you had bonds running up into the end of the year, you had this weakening labor market. You had this kind of, it almost looked like it was rolling over and accelerating. And the reason SAM rule is important, it's not so much, oh, to the tick, it matters. It's the idea that once momentum accelerates, SAM rule is simply a momentum indicator. Once this indicator accelerates, it's hard for labor to reclaim that prior volatility environment and essentially calm back down. It kind of runs away with itself, right? And that issue that we're having here is if labor can't accelerate materially from here, I think that's what bonds are saying. Like, okay, we're looking at the situation where, we could have a weak labor print. It could be problematic, but if the SAM rule is remotely right, it's been right quite well. It's a quite accurate historical indicator. It wasn't right last year, obviously, but if the SAM rule is right on average or most of the time, then momentum needs to materially accelerate in the unemployment market, or the unemployment rate. And for that to happen, it's going to require more than one, possibly even two prints. Therefore, bonds aren't in this position where it's like we need to jump. Like they're not, the gun's not to their head right now. The bonds don't have guns to their head saying you got to jump. And I think that's probably what's helping keep a lid on the bond situation right now, because you have this dollar, you have this capital flows shifting around, coming back home. You're seeing like the euro is up 2% earlier this morning. It faded. You're getting some action in the CAD as well, obviously reshoring some capital from these countries. And when people reshore capital, they're obviously not buying U.S. Treasury bonds, right? So that's probably another negative momentum factor here for bonds. Now, it doesn't mean bonds can't work. It doesn't mean bonds cannot run. It essentially means that the playbook is not as easy as end of 24. It doesn't mean it doesn't work. It just means that there is some resistance. And we're going to have to work through that resistance and kind of unlock the levels to move higher if bonds are going to go higher. And I think one of those things is we need to see some type of momentum acceleration in unemployment. And it's going to take some time for that to happen. It might not, unless tomorrow's NFP print is just, you have like negative payrolls and some ridiculous, like, 4.3, 4.4, and you're really spooking the market. I think labor is still just kind of on the side of the coin where it's like could be problematic, but you're not at the point where the market's like, oh crap, things are starting to break. Yeah. And that's what we kind of saw last summer when we went from 3.9 to 4.2. in like 3 months or 4 months, right? We went up
Yeah.
30
Well,
basis
well,
points
we
in
saw
labor.
we got that huge gap up in TLT when the unemployment numbers came out.
Right.
Yeah, that
And
right there.
that happened on the June release in August, right? So if we look at the July release in August, the July print was here, literally right after Sam rule triggered,
Yeah.
right? So bonds gapping up makes total sense. Now, if you look at the dynamics right now, it's very clear that we're quite a bit away from Sam rule triggering,
Yeah.
and I think that's the situation. The market and you have to be very. Don't take this tit for tat with the SAM rule, because labor is very lagging. It's one of the last indicators to go. So if if the economy has rolled, labor would only start like the acceleration in labor would not happen real time, or the acceleration in unemployment. Sorry, the breakdown in labor, right? And that's the dynamic we have to watch here. And I think that the dislocation in the SAM rule probably sets up the environment for the situation where bonds can have some chop in the meantime. I'm not talking wide ranges, but bonds can, churn around here. Now, if the market takes tomorrow's NFP print as super weak, you could get somewhat of a gap breakout and kind of leg up. But remember how bonds were moving in August of 24? That also coincided with this momentum acceleration in unemployment. I don't know if we're that close yet to seeing that, but obviously tomorrow we will see where that stands.
Yeah, and there's other deterioration that can happen that'll push bonds up before we get that SAM rule trigger, if we ever do get it. Like we've got CPI as well. If CPI goes below target, that's going to work for bonds as well. But right now, it really just feels like bonds are running with a weighted vest. Like we've got the deficit issue hanging on it as well. We have gold. Gold is kind of an opposite at the moment. Like whenever gold goes
Well,
up,
let's
bonds
talk about that.
TLT tends
Let's talk
to
about that.
struggle.
Yeah, so like that's an interesting relationship we've been seeing. And obviously what I think, if you look at gold from a perspective of bond a gold to bond ratio, right? Not just gold outright, you compare it to bonds. Gold and bonds traded pretty much at a 1 point, at a one peg to each other, right? Up and down in correlation. Um for I don't know, 5, 6 years. And then you started seeing this acceleration US deficits. And then you also started to see this acceleration with interest expenses. And gold just absolutely exploded, kind of delinking this correlation, to where, bonds and gold moved relatively in lockstep. And that correlation broke down aggressively over the last 2 to 3 years. And there's always consequences for actions in markets. When gold moves like this in relation to bonds, you create a wave of people that almost value now bonds as the risk off asset. Gold, I'm sorry, as the risk off asset. They no longer look at bonds and say, bonds are a great hedge. Well, they're like, well, bonds have just not been performing as well as gold. I'm going to overweight myself in gold because that's just a superior risk off asset. Like the treasuries, excuse me, are no longer seen as that top dog risk off asset where they were, after the GFC in 2011, going after that, gold severely underperformed bonds. There's actually a great bullish trend in bonds from 2000, I think it was 13 or 4, 2012 or something like that, to 2015, along those lines. This breakdown, bonds went the other way and gold didn't do much. And I think that this environment kind of lulled people to sleep. And this environment waking people back up that gold is a superior hedge to bonds, or at least convincing them of sorts.
And so,
And the
what needs to happen for that liquidity to flow from gold back into bonds? Is it
I
just
think
the deficit that needs to be reduced, or are there other
well,
factors in there?
look here, right? Look at what happened last bond run in the summer. The ratio started rolling over, right? The ratio started wearing down, but gold didn't necessarily fall. Gold was just churning along with bonds. They kind of stabilized, right? And then the ratio took off again as soon as bonds pretty much peaked. The ratio took off again. So we're not in the business of calling tops and bottoms in ratios like this. The only thing that you need to pay attention to with this ratio is, number one, this is a signal of fiscal responsibility, right? And you'll notice that the ratio peaked earlier, pretty much in the last week. The ratio peaked. Well, why? Because number one, the tariffs are going to bring in value for the deficit. That's what's going to happen, right? The tariffs will help the deficit to some degree. They will certainly slow growth, right? But the tariffs at their current position are going to have a positive effect on the gap between which we're borrowing money and which we are receiving money at the government. That's a deficit value, right? That gap has the possibility of slowing/closing. Now, this is how the market's looking at it. The market's saying, okay, bonds are also being taken as a little bit more of a serious risk-off position at the moment, but they're not, like we said, we were looking at bonds, they're not as risk-off as we'd like them to be. They have like a weighted vest. But this is a good early indication. What this ratio tells you in very simple forms is what's going to happen with a deficit. Does the market think the deficit is going to be stabilized, or is it going to continue to run as it's been doing the last couple of years? And if we see this ratio start rolling over, that opens the door for the gold bugs or the gold guys that kind of threw bonds aside, saying bonds are a subpar risk off asset, and say, you know what, if they're going to really fix this deficit and we're going to get this economic shift, well, this as Trump would say, rebalancing the budget, not that he's going to do that, but a severe deficit reduction, bonds then become much more favorable than they have been over the last 4 or 5 years. And if that happens, I would expect capital flows from people that were neglecting bonds as, again, kind of the asset that has to take it on the chin from the government deficit, to something that now can see some light and some positive exposure. And I think that's what we have to watch with this ratio. So far, the 27th high is a high. Let's see, we'll even mark it on the chart and we'll take a look here. We'll see, as long as this holds and roll and slowly glides down, bonds should have that positive tailwind behind them. Thank you guys for listening. If you have any questions, feel free to reach out to us on X at The Market Radar, or go to our website at market-radar.com.